All right, guys, let's quickly take a look at the updated CFTC data for Friday. Now, I know it's something we always cover, but it's always just worth running through this one more time. Whenever we look at things like positioning information, the CFTC data more specifically, it's important to understand that even though we get this information normally on a Friday, sometimes there might be holidays throughout the week, which means the data might be pushed out to the next week, the Monday or the Tuesday, but normally we get it on a Friday. What's important to understand though is that even though we get the data on a Friday, it doesn't show us updated positioning information up until that Friday. It only shows us updated positioning data for that relevant week's Tuesday. So for example, we know that Friday that just passed was the 26th of April. But this information we have for the CFTC data was only updated until Tuesday the 23rd. That's last week Tuesday. That means that all of the price action that we have on a Monday and a Thursday and a Friday will not be included in the positioning information. That's very important to understand because firstly, that shows us that there's always a lag with the data. You're working with lagged information, which in itself, can provide some, can be challenging, can provide some issues for us. And secondly, the thing to always understand about positioning information. Positioning is just one of the tools that we use in our analysis. If you are going to try and only trade with something like positioning information, you are going to run into trouble. In my opinion, after many years of experience, you are going to run into trouble if you are always going to take a contrarian view on any asset that you deem stretched on the short or the long side. That is not how we use this information. We only use this information to try and show us where the markets might be offside. So where is positioning so offside, so extreme, that if we get the right type of catalyst, the right type of trigger to potentially see a much bigger move in the market, something that we can look to take advantage of. That is why we use positioning information and how we use positioning information. So I know it's something we always go through, but it's always just worth sharing that at the start of the video before we even look to discuss or start to discuss the positioning information. So what is the biggest highlights that we saw from the data we got on Friday? Well, the first thing that we still need to focus on here is the US dollar. The Mexican peso is now the biggest net long among the majors, but the dollar aggregate is still second and still massively stretched here. I mean, if you take a look at the chart for the dollar aggregate, just look at that massive amount of long positioning that's been built up for the dollar over the course of the last few weeks in a very short space of time as well. It's been a very aggressive move. And what can we take away from this? This in itself doesn't mean that we just want to go short the dollar right now without even thinking about it. Doesn't mean that this gives us the green light to just short the dollar whenever we want, because this can continue to go up, right? Stretched long can become more long, stretched short can become more short. Why we use or how we use this information is again to give us that low-hanging fruit opportunity, saying that, okay, even if we get positive dollar data, will it be positive enough to see the dollar pushing up even higher? I.e., will it be enough to see these longs being, seeing even more longs being added to the US dollar? If the answer is maybe not, then there's a little bit of asymmetry there for us, meaning that good data might not be as good for the dollar compared to how bad data will be for the US dollar. Because if we get a good enough negative catalyst, bearish catalyst to trigger some dollar downside, that could see a lot of these long positions trimming their long positions. Because remember, if something is stretched long, we don't necessarily want the markets to turn out all out sellers on that asset. We just need all of these longs, or at least a vast majority of them, to take profit on their longs, to trim their long exposure. And that in itself is oftentimes a reason for some big reversals. We looked at this comparison a couple of weeks ago. Well, last week really, and the week before that, and it's just once again good to run through it again. Where we are right now from a positioning point of view for the US dollar is very similar to what we had last year back in October and November. In the exact same way that we were last year, that's where we are now. Back in October, November last year, fundamentals were still bullish for the dollar, just like they are right now. But we saw the markets getting so saturated with dollar longs that we started to get real cautious, saying, you know what, good data just isn't going to be enough to see this trend continue much further. We're waiting for rather to have a negative catalyst to give us a nice trigger to short the dollar to the downside with. And we had ample opportunities going into November and December to do so, as you guys recall. So I'm patiently waiting for my opportunity to look for dollar shorts. We are currently positioned for dollar shorts, but it's not just because of positioning. Of course, it's for the Aussie, for the reasons that we've gone through many times over the last couple of sessions. So we are currently holding a dollar short, but it's not just purely because of positioning. We are looking for that low-hanging fruit. So what does that tell us going into this week's key events? It means that all of those big events like the ISM manufacturing, NFP, services, PMI, all of those things coming out, our preference for those events would be to see really, really bad US economic data and then to short the dollar on the back of that. That would be our preference in a week like this. Now, some other currencies to quickly look at. The other one, of course, is the Aussie dollar. Still stretched, but not as much as it was, 2 and 3 weeks ago. But, something that we've been looking at recently for the Aussie dollar is how underpriced the Aussie dollar seems at these levels. When you look at positioning, it's still stretched to the downside. When you look at index positioning, which is just looking at the Aussie dollar versus all of the other majors, you can see that we're still trading very close to 2022, 2021, 2020 levels, which doesn't really make a lot of sense when you consider the fact that right now the markets are pricing in a pretty aggressive stance for the RBA. Apart from the BOJ, the markets now see the RBA potentially hiking rates again this year. 13 basis points implied tightening for the RBA, not loosening. Now, if you look at the Aussie dollar and positioning, you can ask yourself, is that really accurate? Does this show us a market that is adequately priced for an RBA expectation of possible hikes, or the market expectation for possible hikes from the RBA? I don't think it is. So Aussie dollar, still my preferred currency to trade on the long side right now if we get opportunities. Earlier today, we took profit on our Aussie Swiss longs that we were riding from 2 weeks ago. We took some additional profit on Aussie versus US dollar longs. We got lucky there, trimming positions right off the session highs, and now we're still holding some positions going into this week. So I still like this on the upside for the reasons that we explained, and positioning still very much stretched. Now we come to a currency which I just do not understand from a positioning point of view, as well as a price action point of view. That's the pound. I mean, if you look at the price action in sterling, does this look like a market that has gone aggressively short the currency? Look at this. We are still trading at the index highs we've been stuck at. What's it been now? For the course of the last, let's just say, 6-7 months. And yet positioning is telling us that the markets took a massive dump in pound positioning. This chart for me just makes absolutely no sense. What do I do with a chart like this? I just ignore it. Remember, if something doesn't make a lot of sense, when we can't pinpoint the reason for something or the fundamental drive for something, then it means we need to be a little bit more cautious. And that's exactly what I am with sterling right now. I'm not touching this because what I'm seeing in positioning, what I'm seeing in price action and the fundamentals, there's just, it's a big gray area right now that doesn't make a lot of sense to me. Now, the other one we need to watch for is the euro. The euro, we've spoken about this quite a lot. I mean, take a look at this chart. Do we think the markets have priced in a lot of bad news for the euro? I think so. That means that my preference would be to trade the euro on the long side, again, if we get the right type of catalyst. That means that if we get negative CPI this week, or negative sentiment data, or negative GDP data, that doesn't mean that the euro can't go lower on that. It just means that I don't want to trade it lower on that. I don't think that's where the edge is. The edge for me would be to trade the euro on the long side if we get some upside surprises in inflation, in growth, because the markets aren't expecting that right now. That is not what the markets are priced for right now. I mean, take a look at the ECB. It's not like the markets are hawkish in their pricing for the ECB. They expect this bank to cut first and cut the most out of all of them. So I think a lot of priced on the downside, which is why I would prefer the euro on the upside, and positioning certainly confirms that as well. Now, some other currencies to just be aware of here. The Swiss franc is a big one. It's still stretched short, but look at how aggressive this stretch short position has become. This is, I mean, at historical levels here, guys, something that we really need to keep in mind. Now, this makes it tricky because fundamentally speaking, we have been short the Swiss franc for a while now, right? We've had some fantastic trades on the Swiss franc. I mean, we've traded the Aussie Swiss franc higher. What's it been now? 3-4 times very successfully. We traded euro Swiss higher a couple of weeks ago. Very, very beautiful trade there as well. We've had some good Swiss franc trades, and we've been right about that bearish bias. But positioning matters at these levels. And I mean, take a look at this chart. This is some seriously stretched positioning. So I'm getting a little bit concerned here about a possible short squeeze in the Swiss franc. The reason why we got into the Swiss franc on the short side 2 weeks ago was because we thought that that geopolitical situation flushed out quite a bit of the Swiss franc shorts, and that gave us the trigger to get back into the Aussie Swiss franc, as you guys know. But where we are now, I'm just feeling a little bit cautious. And the other thing that bugged me today, if you take a look at the expectations for CPI, the markets, well, at least Refinitiv at least, didn't give us any updated information for the Swiss CPI data. So without knowing what the markets are expecting, it makes it very difficult to be long, to be short that market right now. So I'm just taking that very patiently. Got out of that Aussie Swiss franc, and that straight short positioning is something that's just, it's bugging me a little bit here for Swiss shorts. Just something worth keeping in mind. Now, in terms of other markets, commodities once again in focus here. We've been looking at things like copper, things like silver, the Bloomberg Commodity Index, palladium. All of these things are still massively stretched long, guys. What does that mean? Does that give us the freedom to just short copper because it's stretched? No, copper has a good reason to go up. It has had good reasons to go up from a demand point of view, from an inflation point of view. It just means that if you are long this market, maybe now is not a bad time to start maybe just, trimming some of that exposure, reducing risk on the trade, taking some profit off the table. Just be a little bit careful with it. It also means that you don't want to be adding new longs right now. I think that is a little bit risky for things like silver, things like copper. Those markets have been pretty stretched to the downside, to the upside, and that is just something worth keeping in the back of your mind if you're going to trade those markets. Right now, I'm hands off when it comes to commodities, as you guys know. They just, apart from copper, they just haven't really traded in line with the fundamentals. So I'm just staying a little bit more patient with it, but it's just something worth keeping in the back of your minds if you are trading those markets actively. So that's just a quick update on the CFTC data. Any questions, as always, don't hesitate to let me know.